Hello, and thank you for joining us for today's market briefing. Today, we will discuss the benefits of rebalancing your portfolio and why rebalancing is an important strategy for achieving long-term investment goals. In buy and hold investing, an investor sets a long-term target allocation to stocks and bonds and then holds those investments for a long period of time. Over time, the portfolio allocation will drift from those long-term targets. For example, a 60% stock, 40% bond portfolio invested in January 2000 would have ended 2019 with an allocation of 64% stocks and 36% bonds. Over that time period, stocks experienced two of the worst bear markets in history as well as two of the strongest bull markets. At the bottom of the financial crisis in March 2009, the portfolio would have held only 37% stocks at a time when the risk-reward for stocks was very attractive. In that environment, not having a full target weight allocation to equities would have caused an investor to miss out on fully capturing their returns during the recovery from the crisis and the subsequent strong stock market performance over the last decade. One way to ensure a portfolio stays in line with long-term target allocations is through rebalancing. By rebalancing back to long-term policy targets periodically, an investor can benefit from reduced volatility without significantly sacrificing returns. Over the last 30 years, a portfolio that was rebalanced back to 60-40 each year would have produced returns similar to those experienced by the buy and hold portfolio, but with a lower level of risk as measured by standard deviation. The result was a higher risk-adjusted return, or Sharpe ratio, for the rebalanced portfolio. 2020 has been a volatile year for investors. Stocks experienced the quickest bear market decline in history, but recovered just as quickly and have since reached new all-time highs. An investor who started the year at 60% stocks and 40% bonds has experienced around a 4.5% return through July 31st, but the portfolio allocation has varied dramatically. At the market bottom in late March, the portfolio would have been closer to 50-50, but by the end of July was back near its target allocation of 60-40. If an investor had been willing to rebalance to targets when the market was declining throughout February and March, the benefit of being more fully invested in stocks during the market comeback would have been apparent. Rebalancing, along with portfolio diversification and time horizon, are key components of helping to reduce risk in a portfolio. By combining a diversified asset allocation with strategic rebalancing, investors can put themselves in a good position to achieve their long-term financial goals. From all of us here at RMB, thanks for tuning in. We hope you're able to join us for our next market briefing.